and welcome to Indianomics. I have a very interesting combination of economists today, a team from StanChart, which represents actually even geographically and in their area of interest, the entire world. I have with me Mr. Yan, who is the professor of economics at Peking University and covers China for StanChart, Mr. Maratheftis, who is the global economy expert for Standard Chartered, the boss of economics at Standard Chartered, if you please, and our own Anubhuti Sahay, a familiar person for the Indian audience, who covers India and South Asia for Standard Chartered. Gentlemen and lady, thank you very much for joining me. You go first, Marios. Is this a year where growth for the global economy is going to be worse than 2015?
Probably yes, and growth in 2015 was not that great to begin with. But despite the anemic and somewhat disappointing global growth, we're not in a recession. It seems that the world economy will avoid a recession this year. Financial markets have run a little bit ahead of themselves. I don't think that the corrections we've seen, especially in emerging markets in Asia, can be fully justified by fundamentals. There is an element of herding behavior. I think the growth areas in terms of countries will be India once again. India has been the bright spot of the world economy for some time. It will probably continue in 2016 as well. In terms of region, I think the growing region, which is doing quite well, is Southeast Asia. China is receiving a lot of negativity internationally. I think a lot of Western analysts are failing to understand the way China is operating, and they're trying to assess China with the proxies that were using 10 years ago when China was very different. But despite the challenges that China is facing, I still expect China to grow at about 6.8%, which is still a high rate of growth for the world's second largest economy.
Oh, absolutely. Let me turn to you, Yan. What is the chance that China will not hard land for a brief bit? We hear a lot of negativity about the Chinese financial system, the extent of bad loans in the banking sector and in the non-banking space. So what is the percentage chance of something bad for just 1 year, or 4% or a 4.5% for 1 year?
I think the chance it will be extremely low if you define hard landing that way. I think the financial market in particular are over-panicking about Chinese economy. I think overall the fundamentals are still strong. So China has a slowing down traditional manufacturing sector, primarily driven by a weak global demand and also weak domestic demand in investment. But China has a booming new economy sector. China is doing very well in the high-end, in developing high-end manufacturing and modern service sector. And China's China's commercial banking sector has rising non-performing loans, but that is not going to lead into any immediate banking crisis. And China still has a 3.2 trillion foreign reserves. So overall, I think China is slowing down primarily because of weak global demand, and also because China is rebalancing into a consumption-driven service sector-led growth. And this means it's a difficult time into switching into a new pattern of growth. But overall, I think China's economic fundamentals are still robust.
Okay. No, 6.8 and no chances of, a sub 5% or a 5% growth is definitely good news. But there is no denying that despite this $3.2 trillion, there are worries about the yuan. Because just 1 year ago, if we had spoken, we would have spoken about $4 trillion of reserves. Now, it's very tempting, and it would be market economics to allow the yuan to devalue because it's clear that money is rushing out. How should global investors look at the yuan? Should we see one sharp depreciation so that it adjusts to economic fundamentals? Is that a possibility?
I think it's possible to see that CNY become more volatile in terms of US dollars, but we think that in terms of US dollars, a larger one-shot depreciation or one-shot devaluation is very unlikely. So I think because of the following reasons. Number one, I think one important external factor of the volatility is the Fed rate hike. So we do not think there will be many times of rate hike in the United States this year. Internally speaking, first of all, as I said just now, China's economic fundamentals are still okay. I think oftentimes it's the market is over worried about that. Second, I think Chinese policymakers have expressed a very firm determination of defend a rough, stable exchange rate, and I believe that they have plenty of tools to do that. They have very we still have a pretty large foreign reserve, and they can have a lot of ways to regulate the market. And also, people worry about the capital flows. But actually,
by the Chinese themselves.
Exactly. But the thing is that China's capital market is still pretty much closed. So what do you see capital flows in December and in January is largely driven by the firms' hedging behavior. So they switch from U.S. loans into domestic loans. And this is coming to an end gradually. So we believe that this will gradually calm down. So we believe that there's no persistent devaluation pressure on CNY in terms of US dollar. Instead, I think CNY will be more stable in terms of basket of currencies.
Okay. Well, there is greater interest in China than any other economy at this point in time since it calls the tune. So some more questions to you, Sayan. Primarily in terms of overcapacity in China. What is the extent of overcapacity in, say, steel, which, just seems to come out endlessly from the economy at prices which the world is not able to match?
Mm-hmm. Well, I think overcapacity in the traditional sectors is indeed a very serious problem. Take steel industry, for example. So last year, China produced about 800 million pounds of crude steel, but people estimate that total capacity of the crude steel is about 1.1 billion tons. So it's about over 20% of overcapacity in steel industry. And I think this, because it is so large, it is about half of the world output. So this
But is there any plan to mothball some of the capacity at all? Because 800 million also seems like excess. Even if it is 20% short of the capacity, it seems to be way above demand. The pace at which it's getting exported and the price at which it is getting exported. So is there a move in China to mothball capacities or cut down capacities, or do we still see 800 million getting produced?
I think so. The policy is going to be a combination of both demand and the supply side. So on the supply side, yes, we are trying to cut the capacities, but because cutting capacity is very complex. So if you do this too quickly, you're going to lead to you're going to cause a high unemployment, and also many of these steel industries are actually local SOEs, and the local government sometimes are reluctant to do this because they do not want high unemployment in their own places. So I think it's going to be gradual. It's a slow, it's a more progressive process. On the other side, I think the demand side is also what policy aim to do, because on one side, so we see this overcapacity because of the weak global demand. So China is promoting one Belt, one Road and trying to increase external demand, and also domestically, I think because this year is the starting year of China's new 5-year plan. So we expect later half of this year we're going to have rising demand for steel. So I think it's going to be a combination.
That's music to the ears. Anubhuti, we've just put a budget behind. What's the sense you are getting about the interest rate trajectory? What is the extent of rate cuts you are expecting in 2016?
We are looking at a 25 basis point rate cut.
That's it.
That's it. I mean, if we look at the inflation trajectory, there are few uncertainties as of now. For instance, while the budget has been presented, we really don't know the extent of pay commission impact, and whether the HRA gets implemented this year or whether it gets phased over years, even for that matter the allowances. So that is one of the most important uncertainty which has to be clarified before we start looking at other factors. Having said that, if we actually look at the structural inflation, just looking at core inflation excluding petrol and diesel, that has not changed at all. It is stuck in a range of 5.2%. So unless we get some space from lower food prices, unless we are very sure of monsoons, I think it will be difficult to talk about further deeper interest rate cuts. But yes, if I have to put a risk at this particular moment to our 25 basis point rate cuts, I'll definitely say yes, there are chances that we can see more, but that would depend on how the food prices pan out, and the most important factor, external headwinds. If we get a shock on the global side, that also cannot be ruled out.
Shock on the global side, that's exactly what we'll be discussing with Maratheftis, and more questions to our panel in a minute after this break.